All right, we're live, Greg. We'll wait for a few people to roll into here. This is Tuesday, 12 o'clock Central Time. We're calling it Lumber Futures from the Free Seats. So I've got Greg Kuta from Westline Capital live with me from Materials Exchange, the digital way to buy and sell lumber. And what Greg and I wanted to talk about today is futures, maybe some of the misconceptions, misunderstandings of them. And Greg and I have been friends and acquaintances for years, so we've chatted about ad nauseum about our excitement about futures moves, our frustrations, our about how we wonder why people misunderstand stuff. Maybe it's education and all that. I mean, I was telling Greg before I launched live here, Mike Wisniewski's at a conference out in the Northeast with, some of the wisest minds in the forest products industry. And on a panel of them yesterday, Mike asked, why don't people use more lumber futures? And these are people that don't run big companies. They basically said, because they're too hard and they create too much volatility. So if people at the upper echelon think like that about lumber futures, you can only imagine how hard of a sell it is when you go through the whole layer of people wanting to hedge to mid management, then bounce up against here. So Greg, Westline Capital Management, great to have you on. Tell us a little bit about you and your company.
Well, again, actually, I'd like to thank you for the opportunity to be here. I think at the end of the day, it's all about the education, and this reluctance to use futures, I think really boils down to a lack of education. And that's kind of where I think Westline comes in. Westline Capital Strategies, I've been on my own since 2009. I've been exclusively trading lumber futures since 1998. So I've seen $135 lumber, I've seen $17.33, and I've seen everything in between. So just to let you know, I clear through StoneX. I work with Alex Mead at StoneX. We collaborate on a lot of risk management products together. So at the end of the day, Westline Capital Strategies, StoneX, we're all about risk management using lumber futures and options. I think we have a very analytical approach where we look at seasonality, we look at historicals, we look at a lot of statistics and trying to build correlation studies to relate futures, not just to Western and Eastern SPF, but studs, Southern Yellow Pine, Euro, Hem-Fir, Doug Fir, the full gamut, and not just for the industry per se, as far as sawmills are concerned, but the entire food chain, from sawmills to wholesale distribution, brokerage, co-ops, retail yards. In the last 12 to 18 months, obviously with the volatility, you've seen a big influx of interest from home builder direct now, multifamily, single family, and then you've seen a lot of private equity show interest as they have to finance these projects. So as much as futures gets a bad rap, I think at the very least, everybody looks at futures on a daily basis. And, like the perfect example today, equity markets are getting clobbered. And I think the expectation was that futures would be up today, kind of spill over with the positive kind of forward moving cash market. And we're down today. And, that's, again, you might not trade futures, but you at least look at the futures screen on any given day.
Yeah, it's crazy. So everybody, Bart Charles said he's glad to see you shaved your beard. I won't say what and anybody say where you're from over in the right, and ask us any questions anytime. Yeah, it's interesting. So at Materials Exchange, what we're starting to get is people outside of the industry, hedge funds, private equity, wanting to get into the lumber business. They didn't have liquidity and they want to trade futures too. And they want to use our platform for liquidity, so they don't have to go through a secondary market and pay that huge vig to get liquidity in and out, right? So maybe there's an opportunity there for all of us, Greg, where we get, which makes absolute sense, right? Because when there's this much basis, big companies look at it and say, "Hey, how can we get in and out of these positions?" And we're like, "Hey, come on digitally and do it, and maybe do futures through guys like yourself, right?"
Yeah, no, I think again it all rolls back to the education, and that you look at a physical commodity industry like forestry, like lumber, and you compare it to other physical commodities like grains or the energy markets or precious metals, industrial metals. The lack of industry participation is mind-boggling. Where 70% of pick a market like grains or pick a market like energies. You probably have 70% industry participation from a commercial standpoint in managing their risk on a day-to-day, week-to-week, month-to-month basis. When you look at lumber, there's this massive hurdle to clear where, again, the idea that futures increases risk is ridiculous. If used properly, it mitigates, it reduces your risk. You look at it from an FX standpoint, you look at it from an interest rate standpoint, yet we don't want to look at it for something that there's inherent day-to-day risk on, something that you speculate on every day in the physical cash market. This is just a natural extension. This is a secondary customer base, and that you have your traditional customer base that you deal with in physical cash. Is there something I could do to offset my risk, to reduce my exposure? And that's where, from a risk management standpoint, as a risk management tool, that's all futures is. It's a derivation of the underlying cash market to transfer some of that risk out of physical cash.
It's funny. What's the old joke in the farming community? A farmer always says, "I want $7 a bushel, but I'll take two." Yeah. Right? I mean, so I think one of the things, let's break it down real simple here. Over the history of the contract since 1969, we've gone from a stud contract to a plywood contract to a hem fir contract to an OSB contract in 1994. We still had the lumber contract. It expanded somewhere in the late 90s from an 80,000 board foot car to a 110,000 board foot car of Western spruce. It still leaves a few delivering mills if they're east of a certain highway and a certain mountain range in the Pacific Northwest. They can still deliver a white hem fir product on some of that. But let's bring up your chart to kind of show a little bit about what the actual contract looks like right now. Does that make sense?
Yeah. Right. And so if you go to, I'm not sure, I think it would be page, let's see here. I think it would be page number 11 and yep. Then 11, 12, and 13.
So start out with CME Random Lengths Futures Contract Specifications. Okay, so let's look at this. And kind of what you alluded to the fact a bit ago. First of all, this is a has physical deliverable capabilities. And you can anybody can actually deliver this. It doesn't just have to be a mill.
Yes.
And that's a misnomer that everybody gets worried about delivery tickets and all that. As long as you hit these specifications of this contract, you can deliver into this, and you can take delivery into it. You may not want. Yeah.
So I'll just add there is that less than 1% of all contracts go through physical delivery. 99.9%, 99%, 98% go through the process of an EFP or exchange for physical, where you have the ability to negotiate not just, if you see this contract's a derivation of Western SPF 2x4s, 8 to 16 tally, mills are very accommodating, or at least the ones that will deliver into futures, where you have the ability, some flexibility to do 2x4, 4-inch, 6-inch. You can do MSR. You can do customized tallies. There are Eastern stud mills that will deliver. So the idea that you have to go through the delivery process, as daunting as it seems, isn't necessarily the case. And yes, technicality, anybody can deliver as long as they have rail side capability and the ability to deliver a contract based upon contract specs. It's called notice intent to deliver. As long as you can deliver something that's written into the contract, then anybody can physically deliver the lumber contract.
Yeah, no doubt. And I think what Greg has alluded to there is a specific ratio of a tele that you have to ship into. So let's talk about why would a person and how would a person that buys Southern Yellow Pine at 10 locations in the Southeast for trusses, let's say, how would they use this contract without having to go to somebody else to broker through a whole bunch of people? How could they use this contract and then EFP it for pine? Could they do that?
Well, I think, first of all, you have to have that relationship, and let's not kid ourselves. The same mills, again, this is a derivation of Western SPF, so a lot of the same mills in British Columbia just have different polo shirts on down south.
That's so true.
It's a lot of the same guys. So, look, if you have that mill relationship with an Interfor, a Canfor, a West Fraser, some of the big players, Talco, that are, are located in British Columbia. A lot of these guys have obviously the relationships down south. I think the big thing, Ashley, is, and this is kind of in one of the slide decks, but we have a tendency to take on the industry's risk. We assume the industry's risk, and when it comes to trading futures, the blanket approach does not work. I think it has to be very specialized and very customized based upon your needs and your wants, your risk. And so for a Southern Yellow Pine consumer, okay, first of all, is there a correlation between futures and Southern Yellow Pine? Well, the answer is it's not an easy answer. You have to look at narrows versus wides. You have to look at Southern Yellow Pine. You have to look at the seasonality. There are different relationships that exist in different quarters of the year. What are you trying to accomplish? And the risk might not be, or the correlation might not be statistically significant. It might not be a 95% or greater correlation, but if the correlation is 70%, 75%, then you can either look at options, you can look at futures, or instead of, okay, we're not going to capture dollar for dollar, but if we can capture 50 cents to 70 cents on the dollar from a risk management standpoint, that's better than capturing 0 cents on the dollar. I think the big misnomer is that, it has to be very geared toward what you're trying to accomplish as an individual company.
I think what's important to know from the history of everywhere I've been before too is there's a correlation and relationship. There's that basis. There's the high end of it, and there's the low end of that relationship, right? So if you're a seller or a buyer in a non-CME, in the non-CME relatable products, you should know what the midpoint of that, the high, the low, and where it currently is, right?
Absolutely.
So when somebody prices you and you're buying from them, you want to know where the high end of that range is, because if they're pricing you at the all-time extreme and you're giving them that risk, you need to know that in order for a counter bid to make them work harder for it. Just as soon as if you're selling something, you want to know the other way too on the risk. So you only educate yourself more by knowing what that basis is when you go to somebody looking for an exotic type of product like that goes against this. So let's talk about.
I was just going to say, if you can go back to slide number 9, there's just a simple slide that shows the definition of a basis.
There you go.
Basis is cash minus futures price, and this applies to any physical cash product minus futures. So futures is always going to be a derivation of Western SPF. Cash can be Southern Yellow Pine. It can be fir. It can be dry. It can be green. It can be Southern Yellow Pine. It can be euro. And again, there are all these correlation studies that exist based upon, we've got data that goes back to 1990, 1991, 1992, depending on the item, depending on the species. So, you can go back all the way. You can look at the last 2 years, 5 years, if you want to correlate it to a certain year. There's all these things that you can customize and build out.
Do you help your clients with that, Greg? So if a Southern Pine Mill came and said, I want to look at the basis on this, or somebody, you would help them look at the history of that. Which is
absolutely
great. That's perfect. That's a great service, because that just educates them and puts more arrows in the quiver, right? Because I think my history has always been, when you go to people to talk about forward pricing, risk management, hedging, basis, a lot of times they don't know, and they won't tell you that they don't know, right? So you educate them so they know, and that helps them understand it more, so they can actually then start looking at potential risk management, right?
Yeah, and so to piggyback off that, Ashley, I think the misnomer is that futures is always going to give you an out. There's always something to do in futures, and through the utilization of these studies, we might find out that there's nothing to do in futures, that you're better off just staying in your physical cash. As much as I want to say, do this, do that in futures, there are a lot of times where futures is not going to be that stopgap to cash, where you're going to be better off just doing what you need to do in the physical cash and paying the cost to carry, or dealing with, the ramifications of cash, where futures is not an end all be all. It should complement your business. And at the end of the day, If there's something to do, great. Let's at least have the statistics behind it to suggest that we do something.
Right now, it always presents something, whether you're forward selling or hedging, right? So right now, with that huge basis that we have, non-traditional basis, maybe we can talk about that. When you have November and January so wide out to what you can buy cash, certain cash items at the historical basis.
So Ash, jump
Yeah,
ahead to slide number 20 and 21, and this
you
will
bet.
give you an historical perspective.
Awesome. Yeah,
Uh,
cool.
so here's the November basis. So the green bar, and this is as of last week. That's the relationship again, cash minus futures. So cash is trading at a substantial discount today relative to the November futures. The next slide is January versus you can see, the average in 2020, 2019, 2018, 2017. You can see a 5-year average, that typical basis this time of the year, November should be trading $20 under cash right now.
What's
You know,
that telling?
November,
What's that telling us?
I think at the end of the day, you have extreme fatigue and exhaustion in this market. When you go from $251 up to 1,000, and then you go from 1,000 to 1,733, float back to 1,000, float back to 7,800, and then collapse down sub 500, sub 450 in cash and futures. You've exhausted both sides of this market.
Man, that's so true. That's so true. We've
And I
talked.
think the open
Yeah.
interest, kind of also backs that up, that we're at historical lows in open interest where this market is just physically, mentally, emotionally exhausted with the recent volatility.
That's so true, and it's crazy because I have people, like I said, outside the industry calling me now from private equity and all that, saying, "Hey, this basis is something people want to take advantage of." I'm like, yeah, but you haven't seen the move. Well, you haven't been sitting in a seat watching this move over the last year, right? You said people are worn out from doing certain things. Reloads have a lot of wood on them. Hell, if you would have hedged at $60, you're getting a margin call for another $60 1,000 now, which you didn't expect. So yeah, you can weather it, but it's a lot every time you go back to your CFO and ask for another $1 million to go to top off your basis, right? They're like, "Hey, what are you doing?" Right? So, but
Yeah, no, absolutely.
that's why what you always preach is you have to have rules. You have to have a reason why you do it, and everybody in the organization needs to be on board and understand that, because volatility's definition is you're going to have drawdowns and you're going to have uh, surpluses in your account. But the point is, basis generally works at the end of the day.
Yeah, I mean, and so the other big misconception with basis is all basis is taking advantage of a discrepancy in the perceived basis between a cash item and futures, and whether futures comes in, comes down, or cash goes up, comes down. All you're looking for is that convergence in the basis. So that could be, okay, November at $620 is going to go, by the end of October is going to be $800 lumber. Well, if that's the case, then cash should rally up. If not 800, should be within $50 to $30 a thousand of November at $800. I'm not saying that's going to happen, but the idea is that as you get closer, as you grind through October, into the end of October, into the spot month of November, you should have a convergence of that basis. And it doesn't mean it has to converge back to historical numbers, but I'm going to tell you right now that at the end of October, there's no way November is going to trade at $120 to $150 premium to cash. Either cash is going to come up or futures is going to come down.
So let's just, we're talking, let's talk about this open interest and maybe back into why, how. I mean, part of this we can explain fatigue. People are worn out. But if you go back and look at 2015, 16, 17, I mean, we had 3, 4, 5, 6, 7, 8,000 open interest. Now, this is a great chart, by the way. We're down below 2,000. What was it this morning? 1,900 something?
Yeah, we've started to build back up off the lows. As of this morning, we were back above 1,800. I think at the low water mark, we were sub 1,700, like 1,690.
So what do you read into this? What's the update? Are there any updates on anything with, I mean, I've heard of other groups looking at potentially launching a non-deliverable Southern Pine contract. I've heard that. I've heard all kinds of stuff. What any thoughts there on this? What can
Yeah.
people do to revive this? Right? Because
Well, I
that's
think, first and foremost is we don't need to settle into $1,000 trading range. I think if you normalized, and again, there probably is a new normal where the idea you're going to float back to $350 and live down there. I think you've always preached this, Ashley, and I completely agree. The low end of a market probably is going to coincide with cost of production, and you can visit those cost of production numbers, but you're not going to live down there in that the sawmills will be forced to react. So I think the downside is more predicated on cost of production type levels. I think, again, one of the biggest problems this industry has is turning the page. We're all fixated with the past, and a lot of people are still dealing with past sins here. Like still purging high-priced lumber. So as you turn the page and have to, kind of force yourself to think about Q1 type needs, you should normalize. You can see from a seasonality standpoint, lumber open interest, and I understand what the parallels between 2019 are very similar right now, but you can see seasonality-wise, open interest has a tendency to bleed out into this time frame. As you get into the seasonal lows around the 41st, 42nd week of the year, the middle of October, third week of October into U.S. Thanksgiving, then you get people to turn that page and start to think about Q1 type building needs. And then associated with that, you'll get a build of open interest. So that's my expectation. The other thing that's going to help this, so right now we're in that 45-day window where the CME starts to calculate. There's a semi-annual calculation of daily price limits in lumber futures. So, between basically August 15th through October 15th or thereabouts, you're going to reset based upon the nominal value of lumber today. So you're looking at, as of today, daily price limits would drop to $28. Expanded limits would drop to $42. So I think those reduced price limits, likely another reduction of margin requirements, all these things will work positively to bring more people back in, or that's the hope anyway.
Yeah, it's crazy. We expanded those limits hoping to stop all the limit moves, and it just continued in our market.
So the other, the CME is governed by the CFTC, and when the CFTC watches a market like lumber repeatedly trade limit after limit after limit, the CME's hands are tied.
For sure.
What they have to do. And why did you get this big expansion of daily price limits? Well, lumber went from $400 a thousand to $1,500 to $1,700 a thousand. So it's a lot easier to react off of that as the market settles down. Unfortunately, it just takes longer for them to rein it back in.
I like this histogram chart. Should we bring the 10-year histogram up that you've got?
Yeah. No, I think this is a phenomenal chart in the sense that you're looking at the 10-year.
Should we go 1 year first? Which is the best one?
Let's go. I think 1 year is a good perspective in that this is lumber average price levels over the last year, and you can see what percent of the time you trade in these price bands. And I think we were all guilty of this. When you look at lumber going from 500 to 1,000, and then 1,000 to 1,500, and then back down to 1,000, the expectation is we were going to reset at a substantially higher price level. That, somehow we've had this paradigm shift. We finally have inflation in lumber. We can justify higher price levels. And then when okay, so this is the 1 year. When you go to that 10-year, you can see in the history of lumber, and we have this data back to, basically back into the 90s. If you want to look at it on a 24-hour clock, lumber above $1,000, you can go to 23 hours, 59 minutes, and 50 seconds. And that last 10 seconds before you get to midnight, there's $1,000 lumber.
That's a good way to put it. Kyle just had a great point up here. Kyle Little from Sherwood. Tighter limits might provide comfort for some. Need to get more involved in increased open interest will provide better liquidity for all. Yeah, no doubt, Kyle. That is so true. No, I mean, look at, I mean, this market, we all kind of get into it. You see the market go to $1,000, and it's I always have been taught and live in the world of cost of production, and that things don't ever change. Whenever the price goes up, somehow people figure out how to get more creep on the market and prices go back down. And so I wasn't a real big buyer into, and again, I had no axe to grind because I had no position on. I wasn't a big buyer into it's different this time, and we're going to see higher norms. Now look at transportation has gone up. Certain inflationary moves have moved the cost of production up. There's no question
Sure.
about that. It's moved the cost of everything up, right? So we've just moved that bottom up a little bit, right? But everything in the world's moved up a little bit, right? But I don't think we're living in that $1,000 or $800 average for the next. Again, guess on my point, right? It just, and your hour clock kind of shows that a little bit.
No, I think to justify substantially higher prices in lumber, you would either see a reacceleration of the rehab renovation component of demand, or you would have to see permanent destruction of supply, not temporary, but permanent, where sawmills close in BC. And, let's not kid ourselves. When you look at geographically where the curtailments have taken place, lowest EBITDA, there's a reason lowest EBITDA is in British Columbia. When you jump into the next province, when you jump into Alberta, your cost of production probably decreases by $100 a thousand. You jump down south, it's substantially less from there. So the industry perceives this as a BC problem, when the reality is it's a North American supply problem. And if you don't like the prices, then do something about it. But if we're solely just going to rely on demand, I think that there are too many headwinds facing demand as far as labor constraints, land constraints, home price appreciation, supply constraints, to where we just can't put all the weight on demand shoulders here to support these higher numbers. There has to be a disruption to supply, where if the mills want higher prices, then do something about it. But I completely agree. I'm looking at the, I think, looking at Kyle Little's commentary, guys like Kyle, guys like Sherwood, guys like you do a great job of education. And at the end of the day, how do you build open interest? It boils down to education, where this shouldn't be perceived as something that's dangerous, that's something that increases risk. At the end of the day, this will help define risk and help your profitability and what you do on a day-to-day basis in physical cash. And it's all education.
So this is basically a BC contract right now. What is in the works to make this more reflective of where the real fiber basket production is, which is the Southeast United States?
Knowing that I was going to come on with you, I touched base with the powers that be at the CME last week. I'm hoping by year end, or potentially sooner, they release a revision to the CME lumber rulebook on the inclusion of Eastern SPF. They're at that point now where they're in the final stages of allowing Eastern SPF to be delivered into this contract. They realistically are going to use Chicago as a centralized delivery point for both Eastern and Western. You'll be able to deliver Eastern. Hopefully that rule book, or that amendment to the rule, comes out before year end. And then, how early would that take effect? Well, you can't implement it in an existing contract. So whatever month has not traded, once they finalize this rule, then it would start in that month. So hopefully by summer or fall of 2022, Eastern mills, technically, based upon contract specifications, have the ability to deliver into the contract. So
and they do such a good job over at the CME. I mean, I've met with them before at other companies. They're a smart group of people over there. I mean, they get it, right? And I know before they do something, they want to know exactly the ins and the outs and what moves what and how it moves. So I'm pretty confident when they do something, they're gonna get it right. I hope, right?
Yeah, no, and that's kind of the CME is very slow and meandering when it comes to all the ramifications that are involved, especially in a physically deliverable commodity. They really have to understand, even if 1% of the people take or make delivery, they still have to have the framework in place in the event that that happens. Can somebody deliver Eastern and take it to Arizona? All these
Yeah, for sure. But
hypothetical, so
there's
that's
some
kind of where they're at.
there's some nuances, and everybody in this industry will figure out which to take advantage of the best little the glitch in the system, right? So,
Yeah, absolutely,
yeah, yeah. No,
absolutely.
so Mike put up, this is from Seeking Alpha. I never trade lumber, but I watch the industrial commodity futures like a hawk. Sound familiar, right? It's like, yeah, I think there was something in Random Lengths one time about 190 people talk about it and 3 people trade it, right? So every time the market's going up, you hear the mills saying, well, look at futures are limit up. Well, do you trade them? No. But when the market's going down, you say the futures are down. They're like, we don't look at that. Right. So it's like we need some more education. It's cool. But hey, look, we're kind of up against a half an hour, Greg. But how do people get a hold of you and talk to you and get some more product? Let's see if we can pull up your contact information on the
I think it's
on chart on the
slide
on
number 25 there.
25. There we go.
Yeah, I mean, obviously you can reach me through here, LinkedIn. You can reach Alex, and look, there are a lot of different people that do this. There are a lot of different brokers. You don't want to deal with me. I'd love to deal with you, but reach out to somebody, whether it's Stone or some of the other brokers. Reach out to Kyle at Sherwood. There are lots of opportunities to use futures, and at the end of the day, you might not want to use it, but I guarantee your competition is using it and using it to their advantage.
Yeah, no doubt. And look, I've got
the people
like
that use it. There is a track record of success. That it's not some kind of magical thing. It's another tool in the toolbox that can be used successfully to add value to your business.
So I have like 35 other questions I was going to ask you that got down more in the weeds into more minutia and options and different strategies. But I think so. Look, if you're open to it, I think we could do a show like this on a regular basis. Let's talk about that and see if we can keep this going, because this is a great way to educate people quickly.
Yeah, no, I'd love to come back on again, Ash. I appreciate the time, and thank you so much for allowing me to do this.
All right, everybody. There's Greg's email address is greg@westlinecapital.com. You also see his phone number and contact information down there. Take a screenshot of that. If you need anything, give us an email. We'll get you everything. Like I said, I've known Greg forever. I trust Greg completely. He's honest as the day is long, and that's 90% of, and he shows up every day. That's 90% of what you can do. And the great thing is he only looks at lumber. So that's a great thing also. So Greg, great having you on. We'll look forward to talking again.
Thanks again. Take
All right,
care.
you bet. Bye.